Hey everyone, welcome back to Corporate Decoder. Today we are diving into something interesting. Ever wondered how a fund that deals with commodities actually makes money or sometimes loses it? Well, consider this your backstage pass to the financial world of Credit Suisse commodity strategy funds. Except in 2025, Credit Suisse Asset Management was acquired by UBS, so it's more a UBS show by then. And if you enjoyed decoding finance, join our Discord community linked below. So what's this all about? It's a report called Form N-CSR, which is like a school report card for investment companies registered with the Securities and Exchange Commission, or SEC. It gives us an inside peek at how they're doing. This particular report covers November of 2024 to April of 2024 to April of 2025. This report covers the Credit Suisse Commodity Return Strategy funds, specifically looking at Class A, Class C, and Class I shares. Think of it like different seating options at a concert, each with slightly different perks, or in this case, costs. One of the first things we will zoom into is how much it costs to invest in these funds. If you had a hypothetical, meaning not real $10,000 investment, its cost will be, for Class A shares, it will cost you $53 or 15% of your investment for 6 months. Class C is pricier at $91, which is the 180%. Class I is the cheapest at $41, which is 1.80. It will cost you $500, which is 1.80%. Class I is the cheapest at $41, which is Evo Class C type of shares. Here are some quick numbers. Total net assets, meaning the value of everything the fund owns minus what it owes, are a whopping $1.2 billion. They are spread out over 80 different investments, which reduces risk. Also, the portfolio turnover rate is 23%. This tells us how actively the fund is buying and selling investments. A lower number like this suggests a more long-term investment strategy. This breaks down where the fund is putting its money. Over 65% is in United States Treasury obligations, which are basically bonds issued by the government and are considered really safe, but yield small returns. Just over 22% is in commodity index structured notes, which are a bit complex, but they are basically bonds that pay out based on how commodities like oil or gold perform. The fund also invested 8.3% in United States agency obligations, think bonds from government-related organizations, and a tiny 2.5% in short-term investments. Now, let's look at where the majority of this fund's money is parked. A big chunk, 11.6%, is in US Treasury floating rate notes, which are basically loans to the government. Floating rate means the interest changes. Almost 10% is in similar notes. After that, it goes into commodity-linked notes from places like the Royal Bank of Canada and BNP Paribas. These notes track commodity indexes, meaning the fund's return depends on how raw materials perform. Looking at these top holdings, this fund is pretty conservative with its treasury bond holdings, but the fund also holds a lot of CDIs, and if the commodity indexes, meaning the fund's return depends on how raw materials perform. Looking at these top holdings, this fund is pretty conservative with its treasury bond holdings, but the fund also holds a lot of CDIs, and if the commodities market dips, things could get dicey in that area. Okay, let's dive into what the consolidated schedule of investments tells us. First of all, just over 22% of holdings are in commodity indexed structured notes. Let's see the biggest investments in this category. $44 million goes to Bank of Montreal Commodity Index linked senior unsecured notes. If commodity prices don't jump, there is a risk the fund performance will be lackluster. Diversification is key in these scenarios. Next up, United States agency obligations, which are about 8%, totaling $10.6 million. These are all pretty safe seeming investments like farm credit banks and federal home loan banks. Finally, a whopping $845 million are parked in United States Treasury obligations. So it appears this fund is mostly betting on the perceived safety of America. Now, let's inspect the fund's futures contracts, specifically if it's buying or selling and at what quantity. It appears the fund is not very good at anticipating market direction given these numbers. They are both buying and selling at the same time, many of the same commodities. For example, they are buying corn futures but are also selling them at the same time. This suggests that the fund does not have a very firm idea of exactly how these numbers will turn out. Finally, let's cover commodity index swap controls. What this means is they are basically offsetting risk by signing an agreement with other financial institutions so they can swap their gains and losses. It seems those institutions are Bank of America, Macquarie Bank, and Societe Generale. What about overall fund performance? The fund has capital stock listed at about $55,000, but a paid in capital of $1.6 billion. Now, at the end of this math, the total net assets ends up to about $1.2 billion across the different classes of holders. Looking at gains versus losses, it seems the fund's investments gain $130 million. It also seems futures contracts helped a solid kekef $9 million, klisi $1.3 million from swap contracts. So things are looking up in the areas where this fund is active. Digging deeper, it looks like there's a shuffle in management. Credit Suisse, which was managing the fund, merged into UBS Asset Management. The board also reviewed information from Broadridge, comparing the fund to its performance group. The total assets for Class I were over $1.2 billion, Class A at $26 million, and for Class C around $3.7 million, and for Class C around $3.7 million, and for Class C around $3.7 million. The key measures of net expenses and net investment income help people see how it is working. They saw that the expense ratio of net expenses or operational costs was fairly within a certain range and agreed with their advisors. Finally, the board deemed all things okay. A notable event occurred where the fund executed a 1-for-6 reverse share split in 2021. This basically means that for every 6 shares you owned, they became 1. This decreased the number of shares but raised the value of each remaining share and has been retroactively applied for easier comparisons. In May of 2025, a press release was issued stating UBS Asset Management reached a deal to sell its O'Connor investment platform, though this is subject to regulatory approvals. Now let's put this all together. The good fund has lots of treasury bonds which are safer. Also, overall, investment gains exceeded losses and some of its management fees were waived. The concerns quotes for fund's performance is just okay compared to key peers, and if the commodities market dips, the returns could face problems. Also, there are changes to the financial institutions managing the fund, which means uncertainty. It shows the fine line these funds walk between opportunity and risk. Alright, that's our deep dive into Credit Suisse. Now UBS commodity strategy funds. What do you think? Are these relatively conservative numbers reassuring, troubling, or surprising? Sound off in the comments. If you enjoyed getting simple corporate insights, slam that like button and subscribe for more simplified breakdowns. Also, do not forget to check out our Discord community in the description below. Thanks for watching.